Hello, my name is Adrià Llach, and together with my group we're going to take a look at the hotel industry around the world. With 18 million rooms worldwide, it generates around 18.2 billion in revenues annually. Around 45% of this market is controlled by branded hotel groups. We're going to take a look at four of them, four of the ones which were profitable in 2008-2009. These are Choice Hotels from the US, Sol Meliá from Spain, Intercontinental based in the UK, and Shangri-La from Hong Kong. There are three main models in which hotels can operate. One of them is owning and leasing. That means the company owns the property, plant and equipment. Another one is managing, which means the company manages third-party hotels that shows up in operating revenues. And another one is franchising, in which companies don't own the assets, don't incur in the operating revenues, in the operating costs. They just receive a stream of revenues from the franchises. The sources of revenue are mainly two: rooms and food and beverages. Some of them have other activities that generate income, such as real estate investments, etc. But we find a certain number of common characteristics among the hotels. Basically, they have a high percentage of property, plant, and equipment, around 60% typically. Depreciation methods then will have a great impact on our balance sheet. Inventories are not significant, and we're talking about a long-term industry. That means usually long-term debt financing long-term assets. Hotels have developed a standard to measure their performance. It's called RevPAR. It basically measures the revenue an available room generates every night, and it depends both on occupancy and room rates. If we look at the trends for the hotel industry, this is data for the US, occupancy has stayed mainly flat during these last 10 years, while room rates have been rising. However, the financial crisis was a hit for the companies. Occupancy went down, prices went even more down, and profit suffered a great cut. A lot of companies are suffering right now. It was hard to find four that were profitable during that period. We're now going to look at the first of them. It's Shangri-La. It's a very new company, but it's quickly become one of the leaders in the upscale hotel market in Asia. It owns right now 65 hotels in 10 countries, quickly increasing. They manage 47 of them. They own 47 of them. They manage just 17. They have around 30,000 rooms, and half of them are in China. Now let's look at the asset composition. As we would expect, most of their assets are property, plant, and equipment, around 50%. Another 20% is interest investments in associates that's partly owned hotels. Their assets are pretty new. Percent used up, it's 25.6%, as we would expect. And despite the quick growth in assets, it's been growing at around 12% annually. Revenues have failed to follow the same trend. Its asset turnover ratio has decreased from around 0.2 to 0.15. Profitability has also decreased. Operating margins, which were around 0.3 in 2007, are now barely positive. Net margins are slightly higher. Now let's look at assets by country, but to know what is working, what is not working. And we see basically that independently on where the assets are located, profits are concentrated in two countries basically, Singapore and Hong Kong, which share some characteristics. They're both countries where investment, financing, commerce are one of their main assets. This means that business tourism has kept on the rise these last years. But look at Philippines, Thailand. Thailand had just 32% occupancy this last year. They have been suffering. Leisure tourism has been going down. That has led to bad results for the company in those countries. Now let's look beyond profits to get a sense of what the company looks like. And we surprisingly find that most of the company is financed by equity. long-term debt just accounts for 33% of its liabilities. That means a low-risk model. Not only low risk, but also a very liquid model. We see how current ratios are around 1.3, 1.4, when the industry average is 1.1. This is because the company wants to keep enough cash, liquid assets to be able to respond to markets that open up and be able to respond quickly. So risk is low, liquidity is high, and the leisure market in Asia is expected to be on the rise again as middle income Chinese people, Asian people enter the market and become part of their customer base. Also, the business market to which the company caters to is expected to keep rising, and shareholders seem to believe the company indeed has bright perspective. They are optimistic, as seen by the rise in share prices during these last 2 years. Now I'm gonna give the word to Sheridan Hyland, which will present the results for Melia Hotels.
Hello, my name is Sheridan Hyland, and I'm going to discuss the Sol Meliá Hotel Group today. Sol Meliá is based in Spain and owns and operates 300 hotels in 30 countries. In the recent past, Sol Meliá has been aggressively pursuing expansion strategies in East Asia and Southeast Asia. Most recently, they signed a joint venture deal with the Jinjiang Hotel Group in mainland China. Let's take a look at Sol Meliá's revenues, profits, and return on assets. Now, as we can see, revenues since 2007 have fallen sharply. And as a result, profits and return on assets have also fallen. This has largely been due in part to the current financial crisis and the fact that Sol Meliá particularly specializes in luxury hotels. The economic crisis has resulted in a far smaller number of travelers worldwide. The middle and upper middle class travelers have had to spend their disposable incomes on necessities rather than on luxury hotel stays. Also, for business travelers, their companies are obviously trying to cut costs as well, and as a result, the business travelers must stay in more affordable hotels. Now, Sol Meliá's profits are directly correlated with its revenues. So the lower the revenues, the lower the profits, as has been the case for Sol Meliá. In the case of Sol Meliá's return on assets, not only has net income been decreasing over the past 3 years, but Sol Meliá has also had to sell a number of its assets. For example, in 2009, Sol Meliá acquired only 2 new companies, but had to sell 9 properties. Let's take a look at Sol Meliá's asset composition and solvency in relation to the industry average. Over the past 3 years, Sol Meliá's current ratio, which measures the company's ability to pay off its short-term debts and loans, has actually been increasing. While Sol Meliá has had to sell some of its assets recently, the company has been very, very careful about monitoring its current assets and maintaining a relatively high level. However, the company has been falling slightly short of the industry average, as we can see here. And this has been mostly because Sol Meliá has focused predominantly on long-term growth strategies, whereas other companies in the hotel industry may have had more flexibility in their growth strategies. Also important for Sol Meliá is the company's risk or debt-to-equity ratio. It has fluctuated in the past 3 years, again because of the financial crisis. Especially from 2008 to 2009, Sol Meliá has had to use more of its debt to finance its assets. However, if we look at the industry trend here, they show a negative net debt-to-equity ratio. And the reason I think this might be is because many companies have had to leverage themselves more and more and more since the onset of the financial crisis. And when we were analyzing our hotel industry, we saw that many of the companies were not profitable, which is why there are some wrinkles in the debt-to-equity ratio. And finally, let's look at asset composition. As you can see, the asset composition between Melia and the industry is more or less the same. The only slight difference is that Melia had a slightly larger PPE in 2009. And this could be because Sol Meliá was able to purchase 4 new acquisitions in 2008 and 11 new acquisitions in 2007, which have been contributing to their asset composition. And now I will let you introduce the Intercontinental Hotel Group.
Hi, I'm Yiru. Today I'm going to introduce Intercontinental Hotels Group. Intercontinental Hotels Group has 7 brands, which cater to customers' different preferences and needs.
IHG is incorporated in Great Britain and registered in England and Wales.
IHG actually focuses on 3 regions, but it basically covers almost every corner of the world. Let's take a look at its market size. IHG, the whole hospitality industry actually has about 18 million hotel rooms, and 45% of which are branded ones. There are 6 major hotel companies in the whole industry, and IHG is one of them. Actually, IHG has the most hotel rooms, and it accounts about 3% of the whole industry. Its business model is also worth our attention. IHG is a predominantly managed and franchised fee-based business, which gives it a more predictable income stream, strong cash generation, and helps it to grow even in the economic downturn, because its new hotels are almost funded by third-party investment. Facing the economic downturn, IHG's revenue also decreased. Actually, it decreased by about 19% in 2009 to 1.5 billion. Also, with its operating profit down probably 34% as well. Despite this, the business model actually has proved it with strong margin performance. Its ROE has been remained at a pretty stable level since the year 2002, without being much affected by the economic downturn. And as we can see here, actually the ratio is 2% higher than the upper quartile level of the industry trend. Here's its assets turnover, and its asset turnover is about the median level of the industry, while its operating margin is much higher than the upper level of the whole industry. For every $1 worth of assets, it can generate about 52 cents of sales, and for every dollar of sales, it generates about 22 cents of operating profit. As we all know, the hospitality industry is very cyclical, usually with 5 to 8 years of RevPAR increase, and then followed by up to 2 years of RevPAR declination. However, the difference this year is maybe because of the slower increase in supply because of the economic condition. The group's RevPAR actually declined 14.7% in 2009, with the declines in both occupancy and the room rates. However, IHG actually relaunched its Holiday Inn brand, and with its growth of new rooms, they both helped to offset part of the revenue lost from the RevPAR declination. And the company has actually also focused on its management of the cash flow. With less cash generated by the operating activities, the company is actually spending more money on investing activities, and also it issued lots of bonds to reduce its term loans. Now let's welcome Ethan. He will introduce about the Choice Hotel for us.